We're here to discuss the Silicon Valley real estate market for the past week ending February the 7th, 2025. These are the key chapters and the visuals that go along with them, so you can jump to the section of the presentation that you find the most interesting for you. We start off with Silicon Valley and then hit the Greater Bay Area, which is 5 regions, 13 counties. Here's the first data slide focused on Silicon Valley. What we're doing is we're doing a summary. We're looking at inventory. A quarter ago, we were at 2,200 listings. Now we're only at 1,500. So we've lost a lot of inventory, and that sounds pretty dramatic. But the reason I have the 3 thin colored lines on here is that's what the market normally does, with the gray line that the cursor's on top of now being what the market typically is. Typical is defined as the median for the past 10 years. The most inventory is defined as the 90th percentile for the past 10 years, and that's 2015 through 2024 is the blue line. The 10 percentile, the least inventory you'd expect, is the 10 percentile is the red line down here. So more important than looking at the raw counts is you're going from 87%, so a 13% shortage or 12.5% shortage, to a 5% surplus compared to that typical value of inventory for this time of the year. Same concept for the number of offers. The number of offers has gone from 79% to 89%. So the number of offers has gone up, but it's only gone up basically 10%, where the level of inventory has gone up almost 20%. So that is a strong indication that we weren't in an inventory limited marketplace, because if we were, offers would have gone up by as much as inventory, the same percentage. If inventory went up 20%, there should have been a corresponding 20% increase in offers. Then more important than either of the two that we just went over is the DUI, Days Unsold Inventory. This is the supply-demand balance, the seller-buyer balance, and it's the speed of the market, the turnover rate of the marketplace. And you won't see you went from exactly normal, from the speed that you would expect the market to be over, to 7% above, which is 7% slower. Longer times, there were more days on the market. I would call it absolutely normal. And you can see that there's been a slight shift in the purple line above the gray line, but that could easily be the calendar year shift. You know, every year, holidays impact the real estate market. The more significant the holiday, the bigger the impact. And we have a huge calendar week. Day of the week that Christmas and New Year's occurs actually impacts how this data plots out. In other words, if we just slipped 1 week, we'd be a lot more on top of this gray line. But the shape is the same. It's basically behaving normal. Moving on to days on market, which is a more typical thing that you hear a lot of people quote. A lot of people quote the average. That's a little misleading, just like the average prices, and the fact that 1 or 2 very long time on the market listings would negatively impact or raise that number up quite a bit. And the median isn't very useful because about 50% of the sellers are selling the house as soon as they are willing to accept offers. So I've done one of the things statisticians do, which is look at the quadrants. I picked the 75th percentile, which is the 3rd quadrant. The reason I do that is that's beyond the level of where the sellers are willing to accept the offer. And more uniformly, it moves more like the average would move, but it's not impacted by 1 or 2 long properties on the marketplace. So that's the reasoning behind using this particular metric. But you can see they've gone from 101%, 102% to 33%. That's a huge shift. You can see we were above the blue line, having longer marketing time than you expect, up until 5 weeks ago. 5 weeks ago, we were crossed over and were right at the normal. 4 weeks ago, you were between normal and typical. 3 weeks ago, you were a little bit below normal for a faster marketplace. Then you were almost approaching the fastest marketplace 2 weeks ago. Last week, we were faster than you would expect. And this week, we're even faster than you would have expected based on last week. So that's a huge shift. One explanation I have, and I don't have any data to prove that this is right, but my hypothesis at the moment is that the inventory is growing a little bit compared to what it normally does at this time of the year. The buyer demand is being satisfied by the new listings, so a greater percentage of the market share is happening in that quick little turnover rate. And the sellers that aren't selling initially are actually having a more difficult time to sell. And that is supported somewhat by the next slide, which is price reductions. Moving on from days on market on to price cuts, you can see price cuts, which is the seller's expectations versus the market reality, was exactly normal at 97%, which was a 1.1% reduction. The reason that number is so small is it's the average, and the vast majority of the sellers do no price adjustments whatsoever. That number has gone down by a factor of 3 now and is only 0.4. So sellers are now taking less than half of 1% of a price reduction on average, and that's less than normal. It's only 76% of normal. And you can see the purple line is on the red side of the gray line, the red side, the hot side of normal. Overbids are not a ratio, but absolute numbers. So a quarter ago, your overbid is 4.6%. A quarter ago, it was actually 6.6. So sellers were getting 2% more than overbidding. That's for almost 50% more than they would typically do. Now they're getting 4.4%. Typically, they're only getting 3.2%. So now it's only about a 33% more overbidding than they typically do. And this is the magnitude, not the frequency. Moving on now and looking long term, we go all the way back to January 1st of 2015. We look at three key metrics. On January 1st of 2024, right here, we roughly double the distance of our x-axis, so it's more spread out so you can see trends. You have in the purple the inventory. You can see inventory has grown up fairly rapidly, and this is a percentage of normal. So this is plotting that gray line. You went from that 74%, 73% of normal just at the beginning part of the year, all the way up now to about 105% of normal. So you're 5% above the normal level of inventory. Meanwhile, the offers have gone only from roughly the same value, 70%, but have only gone up to 88%. So you can see now that if we were in an inventory limited marketplace, offers would be up here somewhere close to 105% of normal. But this is strong proof, in my opinion, that we have not been in an inventory limited marketplace. And then the more important of the three lines is the ratio between the two, the supply-demand balance. You can see it peaked and it's coming back down. So what this is saying is it's saying that offers are catching up a little bit to the supply, and there is roughly a 1 week delay in this, and that's because listings come on this past week. They don't have an opportunity to sell until next week. So there's basically a 1 week lag time in market exposure. Here is just looking at each component individually. So now we're looking at inventory. You can see inventory was limited right on top of the red line. And now you can see at the first of the year, it rapidly left the red line, came up and is essentially right on top of the gray line now. And it's the vertical separation that you're looking at. And on the next slide, what we're going to do is take this gray line and call that 100%, because that's where you'd expect the market to be, and then plot the purple line as a ratio to the gray line. And that visually looks like this. So now that's the gray line pulled out straight, and the purple line now fluctuates around the gray line. So you can see we had a significant shortage of inventory until the first of the year. We rapidly came up, and now basically the last 2 weeks we've had a surplus in inventory. Now, granted, at 5% above the level of inventory you'd expect, it's not a huge surplus, but it still is a surplus of inventory. Moving on to the number of offers accepted. Here you can see even tracing the blue line. And here you can see that vertically you are somewhat above the blue line. You're not above the gray line yet. So I'd expect the next graph to be between the gray line and the blue line. And that's what this graph is showing. You're about 89%, 88.5% of the normal level of offers. So your offers are below the normal level and your inventory is above the normal level. That gives you a days on marketplace, so supply demand ratio, where you're between the normal marketplace, the gray line, and the blue line. And again, it's because it's really hard to see this vertical separation here with the thickness of the lines that I do this next line. So you can see that you started off with a faster paced marketplace at the first of the year. You rapidly slowed down. And now for the last week and a half, you've turned around. And the reason I say week and a half is you got 3 data points served right here at the top. And now the current week data down here, you can see that the market's accelerated this past week. Basically, you've had less inventory coming on the marketplace with more and more buyers coming on the marketplace. And that's what's turned the speed of the marketplace around. Here is looking at days on marketplace. And this is a pretty interesting, if you look at the gray line, your shift is off. The decrease improvement in DOM, days on marketplace, occurred several weeks early this year. It started basically right at the first of the year, maybe even the last week of 2024, where typically you wouldn't expect it to halfway through the quarter. You'd be expecting the turnaround rate to be happening right about now. But this drop off here is roughly equal to the gray line. But now if you come down here and look at the gray line, you're basically approaching record low levels. You had a little bit lower levels back here in 2021 and 2022, but we're at pretty fast-paced marketplace. We're selling 3/4 of the marketplace in basically 15 days. Here now is looking at that compared to normal. Again, pulling the gray normal typical line out straight, you can see that we improved earlier and we improved dramatically. And it's on a percentage of normal. The only time that was faster than we are right now was 2022, right at Valentine's Day, right at the peak of the marketplace, right before we had that major slowdown in 2022. It's interesting to see that the only time that it's been this fast is right before a major slowdown. And that could happen if is this an indication that the buyers aren't buying up the entire inventory? And once the buyers realize the inventory isn't moving away, then they slow down on their overbidding, they slow down on their pace of their buying process, and then we have a market correction. There's not enough data to say that we're going that way, but it's definitely something to pay attention to. Here's the sellers taking the largest price reductions. And here you can see that the sellers have been taking less and less price reductions. But notice the last couple of weeks, the price reductions are leveled off and going, at a time when they're normally decreasing. So again, this is another indication that the market isn't as healthy as it typically is healthy. This is the largest 10%. So it's the sellers that aren't selling immediately. It's the sellers that are hanging on, and then the 10% of the sellers that are doing the biggest price reduction. The reason I'm using this number instead of the quadrant that I use on DaysOnMarket is only about 10-15% of the sellers do any price reduction at all. So by even doing 25%, I'm including a lot of zeros. I want to see what's happening on the extreme of the marketplace, and I can't go any further out. I can't go to like 95% because then you're starting to be influenced more by the errors. There are data entry errors that aren't caught even after I do catch the ones that I catch that will indicate that the original list price was 2 million when it was a typo and it was $1 million. So there you have a 50% reduction on one of the top 10 sellers. But the fact that this is leveled off instead of climbing like the gray line, anytime you don't follow the pattern of the gray line is a time to pay attention. Sometimes the market's cooling and sometimes the market's turning super hot. And that's what you have to pay attention to, is anytime you're not following that normal typical marketplace. It's warning you that something's not typical. Here's pulling out the gray line, and you can see the huge improvement. And now you can see for the last 1, 2, 3, it looks like the last 3 weeks, we've actually slowed down somewhat. And, you might even say that it's been a significant slowdown. You've gone from 80% to 90%, 10%, halfway back to normal, but it's basically overshoot. You can see there's a fair amount of bounce in this particular data point. Now, just so that you have a little bit of confidence that I'm not trying to play statistical magic on you, now we're looking at the average price reduction. So this is all the sellers in a blender, and you can't use the median because the median would be 100%. So you're forced to use the average as a different metric. And this is everybody, including the large zeros. And that's why when you're including everybody, you're only at 0.4% of a price reduction. And you're a little bit less price reduction than you typically are. You were a little steeper than you were. So it may be that we're just catching up to where the gray line typically is. Here is the percentage of average. And you can see that, the last week we slowed down and we cooled off. But is that a 1-week cool off, or is it just sort of bounce? You can see again, there's a fair amount of bounce. There's less bounce in this line than there was in the previous one. Here's the frequency of seller price reductions. So how common? The other one is sort of the magnitude. Now we go to how widely participated, or is it a small number of the sellers? And you can see right now you're on the smaller side of sellers. You're below the gray line. It's the vertical separation. You're above the red line. And you're somewhere 8.8%, 8.9% of the sellers are doing a price reduction. That means 91+% of the sellers are doing no price adjustment whatsoever. Here is the same thing with the gray typical line pulled out straight, and you can see the turnaround from hot marketplace at something like 70% up to now 76% probably. So sellers are taking 25% less price reductions now than they typically do. Here's the magnitude of overbidding. So now we're flipping over and looking what the buyer is doing. And there's also a 5-week lag time on this, roughly. And this time of the year, maybe it's only 4 weeks. Maybe the market's not hot enough for it to be down to 3 weeks. So it's a 4 or 5 week delay at this time of the year. And this shows how much the buyers are overbidding. The gray line, again, is the typical amount of overbidding. and you can see it as a vertical distance. So the buyers are currently overbidding more than they typically do. Then this is the median overbid versus the average, the midpoint. So half the buyers are going in and paying 1.5% above the seller's ask price, and the other 50% are paying less than 1.5% over ask price. And some of them are paying less than ask price, and we'll see that later on. Here's the magnitude of overbidding. So how much, and this is comparing the gray line stretched out. So you're more overbidding than typical. You're overbidding by about 1.25% more overbidding now than you typically are. Here's that frequency of the overbidding. You can see you're above the gray line, so you're having a little bit more frequent overbidding. The amount of overbidding right now is about 58%. So more than half of the sellers are getting more than their asking price in Silicon Valley, which is Santa Clara, San Mateo, and Alameda counties. Pulling out the gray line, you can see that more than 8% more than typical is overbidding. And this is the frequency, so that is correct. So if you were at 58% now, which I believe was the number, the typical amount of overbidding is about 54%, and we can go back and look at that. So your typical overbidding for this week is right about here, which is about 54%, and now you're at 58%. So it's 4% more than typical, which is going to be about 8% more on a ratio, and that's what these two graphs are showing. Now we're looking at the long-term pricing, and here we're going back all the way to January 1st of 2014, and we're showing a little bit into 2013. And we're showing it with a uniform x-axis so that you can draw a straight line and show the appreciation. You can see that we're slightly below the line. It's fairly common to be below the line at the beginning part of the year. What the real question is how much is this going to come up? Is it going to come up and cross over? I will point out that last year we came down earlier and we sort of had a plateau, which is something, and by a plateau, sort of following the typical slope. That's something you don't see in most of the other years. You saw it in the real busy year with the pandemic, but we were inflated above the level that you would expect. And the level of expecting is just a straight line of appreciation. And if you really look at it, maybe the line should be steeper up here and then more shallow here and then almost flat here. It all depends on how you draw the line. But basically, pricing has been fairly flat for the last couple of years, ever since the latter part of 2021. Pricing right now was 1,500 in the second half of 2021, and right now you're slightly you're about maybe 1,550. So pricing has been basically flat. Yes, there's been periods of time when the prices are higher. There's also been periods of time when the prices are lower. This is the median for 3 whole counties, and it could be a little bit of a shift in the marketplace. In other words, if more of the lower priced areas are selling, your median price is going to drop, even though market values do not. So the median sold price did not necessarily reflect on what the market value is of any particular property, which is one of the reasons I got into micro markets, because then it does more accurately reflect property values. This is an estimated of the monthly payments for the different percentiles. The red is the most expensive 90 percentile property that you'd expect. You'd have mortgage payments of about $27,000 a month. That's assuming an 80% 30-year fixed at the high balance conforming rate, which is really going to be a higher payment because jumbo money is cheaper, but the delta between the two stays roughly the same. So this gives you a rough comparison. And the important thing on this graph is to show where the payments are now for the last 2 years versus where they were right at the time of the pandemic. Payments were, not quite half, but they were somewhere around 14,000. And now they're approaching 28,000. So payments on the expensive homes, the most expensive 90% homes, is almost doubled. On the median priced home, you've gone from somewhere around $7,000 to some number around 12,000. So you're not nearly as a higher percent increase. And then the least expense of the most affordable 10% homes have only gone from $4,000 a month to $6,000. So again, about a 50% increase. So both in the cheapest 10% and the median have had a price increase of about 50% on the monthly payments. And I do include property tax estimate and insurance estimate. Meanwhile, your expensive 90% homes have almost doubled in payments. Here now is looking at the days on market. This is looking at a distribution, or we are going to be looking at a set of 3 distributions: days on market, seller ask price reductions, and then buyer overbid. And what we're doing is we're starting off a year ago here on February 7th, 2024, and that's in the dotted line right here. I do bold the purple line, the current data, just for comparison. And notice that the purple line is sagging down right through here. So what this is basically telling me is more of the sellers are selling as soon as they're putting the house on the marketplace, and fewer of the long-term properties are selling, which is why the number here, why this is dipped down, and why this line here at this section is a little steeper than it was a year ago. But the concept is the dotted lines are a year ago. They changed from dotted to dashed lines after a quarter. So they're going back in time. The next 14 weeks are going to be dotted lines. And then we're going to go to dashed lines for 6 months. And then we're going to go to solid lines for the most recent quarter. And the concept here is you can see which direction you expect the purple line to be. In other words, real estate in Silicon Valley is very cyclic. And whatever it did last year is very likely what it's going to do this year, but starting at the purple line level instead of starting at the dotted line level. And let's start going. So you can see the huge improvement, that speeding up of the marketplace. Notice how now the line's pretty well flattened out. There's sort of the peak of the marketplace by April 26, 2024. Now you can see you slow down quite a bit. And then you get to this August, September, October timeframe where you're just basically bouncing around, really not having much of a change. And now when you get to Halloween, you really start slowing down. Here's sort of the peak of the marketplace on the slowness, January the 10th. And now you're turning around and accelerating, and now you're back here. So we are faster than we were a year ago, and you'd expect this to go faster and faster for somewhere until about the middle of April. It moves when the peak happens, and anything can and does happen in real estate and in the world. But right now, if someone was trying to predict what they would be doing, you'd expect the days on market to be coming down further and further. Now we're doing the same thing with the largest price reductions. And by the largest, here is the largest 2.5% all the way down to the largest 17%. So this is basically the 82.5 percentile to the 97.5 percentile. The reason I drop off the top 2.5%, that's where my data is going to be very extreme, and also where my data entry errors are going to be. So I wanted to get rid of the garbage numbers the best I can, but the concept is the same as the last group of slides. Here is where we were a year ago on the dotted line. The purple line is where we currently are. So you're doing less price reductions than this year, but as we step through, you can see that the market's going up to less and less price reductions. That's what you'd expect. There's sort of the peak of the marketplace. It was on March 29th, and then again on April 26th. Now you can see you're improving or cooling off, and you're now getting into the rapid cooling off period of time right here. Boom. And now you're going to start improving since the January 3rd. And we're right there as the current week, and then where we were a week ago. So again, it's the same concept. I expect this line to move up for the next several weeks, then turn around and start cooling off again. Here's the same concept with overbidding. And now you can see that February 7th is just about the bottom of the line. We'll pay attention to the first data slide and see if we expect the market to improve next week or actually slow down. So here we go. There is actually, so the purple line may be the coolest we're going to get this year. And next week, we may be looking at more overbidding. We currently might be at the very bottom of the marketplace. And here we're coming up to the September timeframe, and pretty soon, and there's a 5-week lag. So the slowdown happens quite a bit after Halloween, and it's happening right now. And since this last year was at the bottom of the marketplace, there's a very good chance that next week this number will be higher, reflecting more overbidding as we reflect more January sales. Right now, this week, we're getting rid of the bulk of the 2024 sales. Now we're going to be off next week's data. So we're going to be seeing a larger percentage of 2025 transactions, which is why this is sort of the bottom of the every year. Now we're comparing the 3 counties within Silicon Valley. We're looking at San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. These are the level of inventory. You can see that Santa Clara County has less inventory than Alameda County. And of course, San Mateo, being a smaller county, has the least inventory. This is interesting in that even though I pointed out in the previous slide that Santa Clara had less inventory, they're selling exactly the same amount. I did verify the data points out there. In fact, you can see it a little bit right here, the gray line, and you can see it right here. You can't see it up through here because it's right on top of one another. The numbers are very close together and the lines are getting plotted on top of one another, but both data lines are there. Mateo County has less inventory. All of them are increasing, less offers, and all of them are increasing. So more and more offers, which is what you'd expect at this time of the year. You can come back to a year ago and just see that you expect that increase to happen for quite a long time. Here's the days unsold inventory. So this is the ratio. And because Santa Clara County had less inventory than Alameda County and the same number of offers, it has the fastest market speed of about 31 days. In other words, it would sell out all its existing inventory in basically 1 month. Santa comes in second at 42 days, and Alameda County comes in third place. And it's not like it's bad because it's still 47 days. So in a month and a half, you sell out all your existing inventory at the current rate of sales. Here's marketing time. So how long is it taking 75% of the sellers? Note San Mateo County is flat. That's sort of interesting, and you can see that the pattern last year did flatten out. So I'd expect all that to happen, and we may be seeing this next week. But you can see Santa Clara County is sort of at some of the fastest numbers it's ever been. It's basically right now at 12 days. 12 days here. You got down to 9 days here in early 2022, just before the market collapsed or corrected. And other than that, 11 days is about the lowest number it's had. So if we go down even one more day, that would be significant for Santa Clara County. You can see San Mateo County's up here at 15 days and Alameda County's up here at just over 18 days. So for 3/4 of all your sellers to sell in under 3 weeks across all 3 counties is pretty incredible. For them to be selling in 2 weeks in San Mateo and under 2 weeks in Santa Clara County is phenomenal. Phenomenal, but also to be expected based on what you do every year. Look how far down the blue line comes every year. I mean, to say that 14 days is phenomenal for Santa Clara County at this time of the year is really incorrect. It's phenomenal that happens, but it's predictable. We have that. And the fact that you're at 12 days is a little bit faster than the 14 that you maybe normally are at, but is there really a difference between 14 days and 12 days? Here's looking at the magnitude of price reductions. You can see Santa Clara County is doing the least amount of price reductions, and it's doing about less than 0.1% price reduction on average. And that's, again, one of the reasons I look at what the largest 10% of the sellers are doing on price reductions. San Mateo County is next at somewhere around 0.3% of a price reduction, and Alameda County has the largest price reduction at somewhere around 7.5%. So 0.75% of price reduction in Alameda County. This is the frequency of price reductions. So how common are they? Very uncommon in Santa Clara County, approaching only 6% of the sellers doing a price reduction. In San Mateo County, it increased last week, and it's now at 8% of the sellers are doing price adjustments. And in Alameda County, it's about 11.5% of the sellers are doing an adjustment on their ask price. This is the amount of overbidding that's going on by the buyers. This is the average overbidding. So even though the median was down somewhere around 2%, the average overbidding for Santa Clara County is just over 5%. For San Mateo County and Alameda County, it's tied at basically 4%. That's the average. So someone bidding 20% pulls up the average quite a bit, which is why I look at both the average and the median on this number. The frequency of overbidding, how common is overbidding? In San Mateo County, half of your sellers are getting overbid. In Alameda County, it's 56% and 62% in Santa Clara County. So somewhere between 50%, half, and 2/3 of the sellers are bidding more than their asking price. Here's the long-term appreciation, again, going back to 2014. Here we're again keeping the x-axis the same, and this is on a percentage appreciation. So you can see that Alameda County's got currently the lowest appreciation at only 55% appreciation. San Mateo County comes in around 63% appreciation, and Santa Clara County has the most appreciation at almost about 94.5% appreciation. You can see that appreciation was higher, which means sale price was higher, because I'm using the last 9 months of 2015 for my base. Here is the actual numbers, and you can see that San Mateo County in the orange is now slightly above the blue. It's real hard to see the blue, but if you look on the right-hand side of the orange line, you can see a dot right about there. I actually did away with the orange line to plot where the blue line was on horizontal, and you can see how close the lines are. This is on logarithmic paper. When we go to regular paper on the next slide, you'll be able to see the difference more. And here is Alameda County. So Alameda County, the median price is somewhere around 1,150,000. Santa Clara and San Mateo County are about 1,850. And looking at it on regular paper, now you can see that the orange line is above the blue line. If you look at these numbers, you can read it a little bit easier. Santa Clara County is probably at 1,855, and San Mateo County is probably at 1,865. Those aren't exact numbers. The numbers are later on, so you can look at them, but those would be my guesses. And Alameda County is about 11,500. That's the same information, just plotted differently. This now is the estimated payments, and they go through the same formula. So since San Mateo County is just above Santa Clara, you can see the orange line jumping out from behind the blue line. This is going to be in the same disproportion as the total payment because it goes through the same formula. And here you can see Alameda County is on the median price. And again, you can see that the price for Alameda County, the payment is the same as what it was in 2022. For San Mateo County and Santa Clara County, payments are the same as they were in 2023. Here now we're looking at micro markets. The huge advantage of micro markets is you're grouping similar priced homes, and market shifts, be it from Cupertino to East San Jose or from East San Jose to Cupertino, are minimized because you're grouping similarly characterized homes, similar market price, similar days on market, similar ask price, as similar as you can get in the non-homogeneous real estate marketplace. This is the active inventory compared to normal. So areas with blue being the sort of the moderate affordable areas in Santa Clara County have more inventory than they typically do at 34%. Your Campbell, Santa Clara, Willow Glen area actually has the least amount of inventory at only 67%. You can see Santa Clara County as a whole, Silicon Valley as a whole has 5% more inventory than normal. Santa Clara County is 91%, so Santa Clara County has the shortage. You come down to San Mateo County and it's at 7%, so that's probably going to be the most inventory of all three counties, and then come down to Alameda County at basically 4% more inventory. So you can see Alameda County and San Mateo County are basically white, which means they have very close to normal. Basically, I use about 12.5% on either side of normal to be normal. When you're starting having red, it's a shortage of inventory. When you have blue, it's a surplus of inventory. Here now is the number of offers. So a shortage of offers very pronounced on the San Mateo County coast. You can also see the blue sort of in the southeast portion of Santa Clara County, as well as the northern portion of San Mateo County and Foster City, although I will mention Foster City is a very small area. Bulk of Silicon Valley is probably white in color, which would be about the normal level of offers. Here's the days unsold inventory. So this is compared to the normal, that 10-year normal. And in Alameda County, I only have county-wide data for the first three data sites, this being the third data slide. You can see you have a slower marketplace here, sort of in the southeast portion of Santa Clara County, faster paced in Campbell, central part of the Santa Clara County, and Redwood City is faster paced. You got 4 areas of blue in color, which is the slower, and again, the significant area in white, which would be roughly normal marketplaces. You can see that Silicon Valley is at 107%, which is slower than normal. Santa Clara County's at 95%, so that's a little bit faster than normal. San Mateo County is at 120%, so quite a bit slower than normal. And then Alameda County is at 107%, so it's slightly slower than normal. Now we're getting rid of comparing to normal and just looking at the absolute speeds. You can have a fast-paced marketplace that is slower than it typically is. In other words, it would be super fast. But here you can see that the vast majority of the valley, Silicon Valley, is red in color, which would be a fast-paced marketplace. You have the expensive areas in San Mateo County and the San Mateo County coast, which has hints of blue. If you look over here, you can also see Hayward's got a little bit of a blue hint to it right up here. Everywhere else is either white in color or the majority of the areas are pink in color, meaning a faster paced market than normal. Here's marketing time. So this is simply looking at the 75th percentile. You can see that most of the areas are red in color. which means that the sellers are selling, 3/4 of the sellers, 75% of the sellers are selling in less than 3 weeks. The only one exception that you have is the expensive areas in San Mateo County at 60 days, where it's blue in color. The coast is another exception at 42 days, which is white in color. Here's the seller's ask price adjustment, and this is on average. You can see we're basically red in color, with Alameda County seeing sort of the least amount of price reductions. Oakland has the most at full 2%. San Mateo County coast sellers are doing a 1.4% price reduction on their asking price. Atherton is close behind at 1%. Most of the numbers, as you can see, are sub 1%. Here's the frequency of the ask price reduction. So how common are price reductions? Very common in the San Mateo County coast, with 1 in 5 sellers doing a price reduction. 1 in 5 in Oakland. Everywhere else is basically very uncommon. Red in color is very few sellers. You know, some of these numbers: 0% in Cupertino, Sunnyvale, 3% in Campbell, 2% in Los Altos. That's basically hard to find a seller that's doing a price reduction at all. Here's overbidding. So what are buyers doing? You can see in the San Mateo County coast, they're actually going in 6% below the seller ask price. So instead of an overbid situation, you have an underbid situation. But most of the valley, Silicon Valley, is pink in color, which would be a slight overbid. Here's the frequency of that overbidding. Red in color is very common. The densest red that I'm seeing is going to be Cupertino at 81%. But, you know, you have Fremont at 75%. You have Foster City very small at 87%. The one area that's having no overbidding is the San Mateo County coast. So no sellers are getting more than their ask price over there currently. This is long-term appreciation. You can see that sort of the moderate commute areas are the areas that have done the most appreciating recently. The outlying areas, now that we're working, is less flexible and more companies are forcing more employees back more often. You can see the longer commutes are becoming less desirable again and having less appreciation. And then the very desirable close-in locations have had less appreciation because the buyers aren't willing to pay as much of a premium as they did historically. Here's the sold price, and instead of following the median number, which is the middle number, as most people do, I also add in the 10 percentile on the left and the 90 percentile on the right. So you have a range. So for Santa Clara County, for example, you can expect single-family homes to sell between $1.1 and $3.8 million. Now, yes, there are homes that sell for less than 1.1 million, but that's less than 10% of the total transactions. And yes, homes sell for more than 3.8 million, but again, it's less than 8%. So you can quickly find out how likely is it you're going to find a home in any one of the 20 micro market areas in Silicon Valley. Here's a summary chart of what we've been going over. So you can take something like the San Mateo County coast right here, item number 22, and see how blue it is all the way across. And then you can take something like Cupertino and Sunnyvale and see how red it is all the way across. Basically, the first 3 slides are comparing to normal. The next several are market conditions. And then you get into appreciation and pricing, which really doesn't tell you current market conditions. It tells you more how that area is done over the long term. Here now are the actual numbers, so you can see whatever data number you want. In fact, we talked about Santa Clara County. It's at 18.6 and San Mateo County was at 18,750. So they're both probably slightly higher than I thought they were and closer together than they thought they were. There's only $15,000 separating the two. Here is the number of offers accepted. This is on here to show that last year was the least number of offers out of the last 25 years. We're now at 13,2015. So this is the second worst. We got 2 here, which is going back to the end of the year, which were the worst that we had in the last 25 years. 3 weeks ago, which is January the 10th, we're at 808 versus 802. For all practical purposes, those are the same. We still have more transactions that could possibly fail, and there's a very good chance that 2025 will become the least amount of offers out of the past 25 years. It's too close to tell on the more recent data because a larger number are done at TFT, but I'm not sure it's enough to overcome. The current week, I'm almost confident that we're not going to see a drop down, because actually next week we'll see the 1315 most likely increase before it starts dropping down. And that's because it's a live database. As transactions fail, I update my data for 13 weeks. So most transactions are closed by 13 weeks. So by the time I finish updating the data, it becomes fairly stable. We have been talking about Silicon Valley real estate marketplace, and we'll be talking about the Greater Bay Area, 13 counties and 5 regions next. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is down here for you at the bottom of the page. I represent either buyers or sellers in transactions here in Silicon Valley. If you would like to get to the archive of these presentations, you can type in the lengthy blue YouTube link and go directly to the channel, or you can type in the shorter green root URL. The advantage of the green root URL is if you add 2025, you can join the live presentation Saturday morning at 9 a.m. If it asks for the passcode, meeting passcode on Zoom, it's right here for you. If you'd like to see the handout, the PowerPoint handouts that we've gone over, type in the green root URL, H for handout 2025 0208 for today's date. And any specific past episode you can get there by typing the green root URL plus the year, month, date code. Let's move on to the Greater Bay Area. These are the 5 regions. We've been talking about the first one, Silicon Valley. Then we have San Francisco and Marin. I sometimes call that the cities, North Bay, Sonoma, Napa, Solano, and Contra Costa County. Central Valley is made up of Sacramento and San Joaquin, and the Central Coast is Santa Cruz and Monterey. Like Silicon Valley, we're using 2015 through 2024 as our base 10 years. Here is that data for the past 10 years, and you can see inventory in all 5 regions is going up, except for Central Coast, where I would basically say it's flat. You can see it actually went down a little bit this last week, but I'd call that flat. So Central Coast is sort of bucking the trend and did not go up this last week. This is the number of offers. Here you have unanimous, all 5 regions are going up. You have a 3-way tie here for Central Valley, North Bay, and Silicon Valley, right around 1,300 transactions in the past 5 weeks. So because they're much smaller in size, the Central Coast and North Bay are much smaller, just around 600, maybe 700 transactions in the past 5 weeks. These are the number of days of unsold inventory, the speed of the marketplace. You can see all 5 regions here are also going down. Silicon Valley being the fastest, the slowest being Central Coast. The other 3 being fairly close. Well, they're all fairly close together. You're basically from 40 days to just over 85 days for the slowest. So all within a range of 40 days. And to sell everything in under 3 months is pretty rapid. And historically, there's very little time where we're over 3 months. Yes, it does happen, but it's very infrequent. This is marketing time. How long does it take to sell 3/4 of the properties? You can see by far the fastest is Silicon Valley, it's right around 15 days. Then you jump all the way up to 48 days for the cities. Then you're going Central Valley at 58 days, Central Coast at 67 days, and North Bay at 70 days. Moving on to the seller's ask price reductions. This is a good indication of where the seller's expectations are compared to the market realities. You can see Silicon Valley is doing the least amount of price reductions at somewhere around 0.4%. That is sort of less than half of 1% that I consider to be a balanced marketplace, where the marketplace is typically expected to be a little bit on each side of half of 1%. So we're clearly well within the range of normal for Silicon Valley. You can see that next is the cities at almost, call that 0.9% price reduction, but then you start going up. Then the Central Valley is next at 1.2%. Then you have a North Bay at somewhere around 1.5% price reduction. And the largest geographical area that's doing a price reduction is the Central Coast at 2.2%. Here's the frequency of seller's ask price. So how common are the price reductions? Least common in Silicon Valley with less than 9% of the sellers doing a price reduction, then the cities at something like 14%. Then you jump up to basically both sides of 30%. You basically have Central Valley and North Bay at 28% and Central Coast at 31% of the sellers doing a price reduction. You go from 10% to 30% of the sellers are doing a price reduction. Overbidding, this is the magnitude of overbidding that the buyers are doing. And you can see 2 of the areas are below 100%, being the Central Coast and the Central Valley are both below 100%. So the sellers are actually taking a price reduction when the offer comes in the door. North Bay is right at 100%. And then you have cities at 4% above and Silicon Valley at 4.5% above the seller's ask price. So the only place where you have any significant overbidding going on is the cities in the Silicon Valley. Here's the frequency of overbidding. So how common is overbidding? The most common in Silicon Valley at 58%. Then the cities is second at 48%. North Bay is about 38%. And then we break the trend and we have the Central Valley at 34% and Central Coast at 26%. Here's the long-term appreciation. I'm using the last 9 months of 2015. So this period of time when prices were somewhat stable. And then you're coming up here and looking at current prices. The least well is the cities. So San Francisco has really been hit hard by the pandemic. You can really just visually see that. You can see that all the areas were sort of grouped together. Maybe Silicon Valley was a little bit on the high side, but the cities, the orange line was well within the margin of all the other areas until the pandemic. And then it came out on the bottom, and it's been on the bottom ever since. So the San Francisco and Marin has definitely been hard hit with the pandemic. The area that's doing the best, and probably because of remote working, is the Central Valley. Second is Silicon Valley at 78% appreciation, Central Coast at about 68%, and then the North Bay at about 57% appreciation. And that's really fairly good when you're considering you're talking about only 10 years and you're talking about most likely purchasing your home when you're leveraged out. So your rate of return on your actual investment is quite a bit larger than the actual appreciation. Here's the median sold prices for the different regions. You can see that the most expensive area here is Silicon Valley, which is Santa Clara, Alameda, and San Mateo counties. Second is San Francisco and Marin. That's reversed, and it's been, historically, San Francisco and Marin's been the most expensive, and then you had brief periods of time and very close periods of time. But you've been underneath now for a significant period of time. We'll see what happens. The Silicon Valley may become the new, more expensive region. Central Coast is in the middle of the pack at just over $1 million. North Bay is somewhere around $750,000, and the most affordable area is the Central Valley, just under $550,000 for the median priced home. Here's the monthly payments. PITI, assuming 30% fixed loan, they're in the same order as the house payments because they all go through the same formula. But this allows you to take into consideration and changes in interest rates and see what the payments are. This is a chart that's interesting for those that believe people buy a house on the monthly payments, not on the purchase price. Here is a table packed of numbers. You basically will go over one example here. In Santa Clara County, you had active inventory of 468 this past week. That's up 9% from a week ago, and it's up 33% from 5 weeks ago. That's how you read each one of the tables. When you don't see the percentage sign, it's raw numbers. So, for example, on days unsold inventory currently at 37.7, that's a reduction of 4.4 days from a week ago, but it's up from 13.3. So you have to take a moment and think through what the significance is. As days unsold inventory increases, the market slows. So the market is slower now than it was 5 weeks ago, but it's better or faster than it was just last week. And so you can see there's a lot of information on here. The highlighted yellows are sort of leading indicators. The white really don't tell you anything. And the orange are lagging indicators. Here you can see the price in thousands. So the price actually is down $25,000 from a week ago in Alameda County. It's up $3,000 in Santa Clara County or in Silicon Valley. I have all 13 counties up here. For regions, I only have Silicon Valley and the Bay Area. I don't have the cities, North Bay, Central Valley, and the Central Coast as regions. With that, we're back to the beginning. So not seeing any unmuted mics. Have a great week. These are, again, the chapters you can jump to in the YouTube description at the bottom. Have a great week. Thanks for listening. Take care. Bye for now.